The rise of covered call ETFs. High yields for income-focused investors. Covered call ETFs have been gaining immense popularity, particularly among income-focused investors. These funds are designed to pay out substantial dividends, often on a monthly basis, and in some cases, even weekly. Many investors utilize these funds to maximize portfolio income, with the goal of achieving financial independence through dividends. But what exactly are covered call ETFs? What advantages and trade-offs do they offer? Which are the best covered call ETFs available? And most importantly, are they a suitable investment for you? In this blog, we'll explore everything you need to know about covered call ETFs to help you make an informed decision. What are covered call ETFs? Covered call ETFs follow a relatively simple investment strategy. These funds hold a portfolio of stocks and generate additional income by selling call options on those stocks. The income generated from selling these options, known as premiums, is then distributed as dividends to investors. The key point to understand is that because these funds distribute their premium income as dividends, the monthly payouts can vary significantly. This is a crucial consideration for investors who rely on consistent income streams. The popularity of covered call ETFs. The growing interest in covered call ETFs is evident from the increasing number of new funds entering the market, each offering attractive dividend yields. Some of the most popular covered call ETFs include JEPI, JP Morgan Equity Premium Income ETF, 7.2% starting dividend yield. QALD, Global X Nasdaq 100 Covered Call ETF, 12.3% starting dividend yield. SPYI, NEOS S&P 500 High Income ETF, 12% starting dividend yield. How do these ETFs generate high yields? The high yields offered by covered call ETFs are primarily generated through the sale of covered calls. Here's how the process works. The ETF holds a portfolio of stocks. It sells call options on those stocks, collecting premium income. This premium income is distributed as dividends to investors. Since the premiums fluctuate based on market volatility, the dividend payouts of these ETFs can also vary significantly. For example, JEPI's historical dividend payouts have ranged from as low as 26 cents to as high as 62 cents per share, depending on market conditions. The role of market volatility. Market volatility plays a crucial role in determining the premiums generated by covered call ETFs. When market volatility is high, option premiums increase, resulting in higher dividend payouts. Conversely, when volatility declines, the premiums shrink, leading to lower payouts. A useful metric to track market volatility is the VIX, S&P 500 Volatility Index. Historical trends show that during periods of market turmoil, covered call ETFs can provide higher income, whereas in stable markets, the payouts might be lower. Trade-offs of covered call ETFs. While covered call ETFs provide high monthly income, they come with significant trade-offs that investors must consider. 1. Capped upside potential. By selling call options, the ETF limits the potential for capital appreciation. This means that in a strong bull market, covered call ETFs may underperform compared to standard equity ETFs. For example, QILD writes covered calls on 100% of its portfolio, meaning all of its holdings have capped upside potential. Over the past 5 years, QILD has returned about 43% on a total return basis, but in terms of stock price appreciation alone, it is down about 22.6%. By contrast, SPYI covers only 75 to 90% of its portfolio with covered calls, allowing it to participate in more of the market's upside while still generating premium income. 2. Options moneyness. A key factor. The type of call options sold by a covered call ETF also affects its performance. Here are the 3 main types. At-the-money ATM calls generate high premiums but cap almost all upside, e.g., QLD, XYLD. In-the-money IDM calls provide the highest premiums but eliminate nearly all upside potential, less common. Out-of-the-money OTM calls generate lower premiums but allow for some stock appreciation, e.g., JEPI, DEVO. DEVO, for instance, has a relatively low dividend yield, 4.51%, compared to QYLD but has seen better capital appreciation, returning 13.84% over the past year. Tax considerations. Tax efficiency is another crucial factor when evaluating covered call ETFs. Not all covered call ETFs are taxed the same way, and understanding these differences can help investors optimize their tax burden. 1. JEPI's tax inefficiency. JEPI generates income using equity-linked notes, ELNs, rather than directly selling call options. ELNs are taxed as ordinary income, which can result in a significant tax burden for investors in higher tax brackets. For example, if you're in the top 25% of taxpayers, AGI between $85,000 to $150,000, you could owe up to 17.7% in taxes on JEPI's income. 2. SPYI's tax efficiency. SPYI and other NEOS funds use index options classified as Section 1256 contracts, which benefit from 60% long-term capital gains tax and 40% short-term capital gains tax. This classification significantly reduces the tax liability for investors. Additionally, SPYI's dividends are often classified as return of capital, which isn't taxed as income but instead reduces the investor's cost basis. For an investor earning $50,000 in dividend income, JEPI, approximate $8,850 in taxes. SPYI, approximate $790 in taxes. Best covered call ETFs for different strategies. Given all these factors, different covered call ETFs may suit different types of investors. Here's a breakdown based on investment goals. Investment goal. Recommended ETF. Key features. High monthly income. XYLD, XYLD. ATM options. High dividend yields, 10 to 12%, but capped upside. Balanced income and growth. JEPI, DEVO. OTM options. Moderate yields, 4 to 7%, with some upside potential. Tax efficiency. SPYI, XYLD. Section 1256 tax treatment, lower tax burden. Real estate focus. IYRI, NEOS Real Estate High Income ETF. Covered calls on REITs, high income potential. Final verdict. Are covered call ETFs right for you? Covered call ETFs can be a great tool for income-focused investors, but they are not for everyone. The key considerations include investment objectives. If your priority is maximizing income, covered call ETFs may be ideal. Time horizon. Investors with a longer time horizon who want capital appreciation may be better suited for traditional ETFs. Risk tolerance. While covered call ETFs reduce volatility, they also limit upside potential. Tax considerations. Funds like SPYI offer better tax efficiency compared to JEPI. Ultimately, if you are looking for high monthly dividends, some downside protection, and are comfortable with capped upside, covered call ETFs may be a valuable addition to your portfolio. However, carefully selecting the right ETF based on tax efficiency, option strategy, and market conditions is crucial. Let us know in the comments which covered call ETFs you prefer and why. And as always, don't forget to like and subscribe for more financial insights.